All right, today we're going to pull back the curtain on the investing genius of Warren Buffett. We're going to break down how he thinks, not as some frantic stock picker, but as a calm, cool business owner. And you'll see how that one simple shift has made all the difference. Let's dive in.
So let's just start with a question I think we've all asked ourselves at some point. You look at the charts, the crazy ups and downs, the panic, the euphoria, and it's really easy to think, you know what? This is just a giant casino. It feels like a game of chance where the house always wins.
But what if I told you that from 1964 until today, one company's stock grew by over 115,000%? Get this, a single share went from just $19 to over $22,000. That's not luck. That's a system. Someone figured out how to beat the house.
And that someone, of course, is Warren Buffett. What's absolutely wild is that if you go back to the 1993 Forbes list of the richest people, he was the only one on there who made his fortune mainly by investing in stocks. That tells you everything. He wasn't just playing the game better than everyone else, he was playing a completely different game altogether.
So what is this different game he's playing? What's the secret sauce? Let's get right into the core principle that really drives his entire philosophy.
First thing you got to understand is what Buffett ignores. He has absolutely zero time for market predictions. All those talking heads on TV yelling about where the market's going tomorrow or next week, to him, it's just noise. It's a distraction. And this quote, it just perfectly sums up how he feels about it all.
And here it is. This is the big reveal. The secret, the core of it all, is this profound shift in your mindset. You have to stop thinking about buying a ticker symbol that just bounces around on a screen and start thinking about buying an actual piece of a living, breathing business.
This slide really lays it all out, doesn't it? On one side, you've got the speculator. They're obsessed with the stock price, what the economy's doing, asking, is this thing going to go up? But the owner, they're on a totally different wavelength. They're focused on the actual business, its real value, its future. They're asking a much better question. Is this a good business? So how does Buffett deal with all the market's craziness? Well, he uses this fantastic little story from his mentor, Benjamin Graham. Imagine you're in business with this guy, Mr. Market. And, well, Mr. Market is a bit of a mess. He's wildly manic-depressive. So on his good days, he is just on top of the world. He's euphoric, convinced the future is paved with gold, and he runs up to you offering to buy your half of the business for some crazy high price. Now, a speculator gets swept up in that excitement. An owner, though, they might just see a great opportunity to sell. But then there are the bad days. And on those days, Mr. Market is a wreck. He's panicking, certain the sky is falling, and he comes to you begging you to buy his shares for pennies on the dollar. For most people, this is when fear kicks in. But for the business owner, this is where the real opportunities are found. And here's the big takeaway. Mr. Market is not your guide. He's there to serve you. You're supposed to use his mood swings to your advantage, not get swept away by them. But, and this is a huge but, as Buffett says here, you have to know what you're doing. The market is not kind to the uninformed. Now, Buffett didn't just invent all of this out of thin air. His strategy is really a powerful combination of ideas from two absolute giants of investing. Let's take a look at how he blended their thinking. Okay, so on one hand, you have Benjamin Graham, who was like the professor. He was the numbers guy. He taught Buffett to figure out what a business is actually worth, its intrinsic value, and then only buy it if you can get it for way less. That's the famous margin of safety. On the other hand, you have Philip Fisher, who was more like an investigator. He was all about the quality of the business, finding truly fantastic companies with amazing management. Buffett's real genius was taking Graham's price discipline and combining it with Fisher's focus on quality.
So, how does he actually put all this into practice? Well, he uses a surprisingly straightforward 4-part checklist to size up any company just as if he were about to buy the whole thing outright. First, he looks at the business itself, and the first question is so simple. Can I understand this? Can I explain how it makes money in one sentence? Then, does it have a long, steady track record? And this is crucial. Does it have a durable competitive advantage, what he calls a franchise or a moat that protects it from competitors? Basically, he stays inside his circle of competence, only playing in games he knows he can win.
Next up, he looks at the people running the show. Are they smart about how they spend the company's money? Do they treat shareholders like partners and tell them the truth, the good and the bad? And maybe most importantly, do they think for themselves, or do they just mindlessly follow what every other company is doing?
Third, the numbers, but not the numbers everyone on Wall Street obsesses over. He couldn't care less about quarterly earnings per share. Instead, he looks at things like return on equity,
which basically shows how good a company is at turning shareholder money into more money. He calculates what he calls owner earnings to see how much actual cash the business is throwing off. And he has this great little test. For every dollar the company keeps, does it create at least one new dollar of value for the owners? Simple, but powerful.
And then finally, after all that other homework is done, then he looks at the price. Based on everything he's learned, he figures out what the business is actually worth, its intrinsic value. Then, and only then, does he look at the price tag Mr. Market is offering that day. And he waits with incredible patience until that price is way below the real value. That gap between the price and the value, that's his margin of safety.
Look, this all sounds like a lot of work, right? And it is. Which leads us to this final, really powerful metaphor that just brings this whole disciplined approach into perfect focus. Just let this sink in for a second. Imagine that for your entire life as an investor, you get a card with only 20 slots on it. You can only make 20 investments. Ever. That's it.
What does a mental model like that do to you? It changes everything. You immediately stop speculating. You stop chasing hot tips. It forces you to be incredibly selective. You're no longer looking for a quick trade. You're looking to own a piece of an outstanding business that you've thought about deeply and understand inside and out.
So I'm going to leave you with that question. The next time you look at an investment, don't ask if the stock is going to pop next week. Ask yourself this: is this business at this price so good that it's worth one of my precious 20 punches? Answering that one question, well, that's the essence of thinking like an owner.